APC, accounting for your future.
Hi, this is Steve from APC and I'm the course director here at APC, and in this video we're going to be focusing on the bank reconciliation statement. So what do I mean by bank reconciliation statement if you think about it in this way? So we've got the cash account, which is the T account within the company, with debit as well as the credit side. And also we've got the bank statements that is given by the bank. So why this is the case is because we open up our bank accounts into our bank, okay, for every businesses. So maybe we're going to use the bank transfer to transfer the money from our bank to others. Or maybe to some extent we received a check, maybe from a customer, but we haven't gone to the bank to clear up this issue. For example, we received a check worth of 100 from our customer A, but we haven't gone to the bank to receive this 100 to update the amount within the bank account, because it's just the check, just the payment that we received, but we haven't gone to the bank. And hence, of course, there would be a difference between the cash account within our company and the bank statement figures from the bank's perspective as well. So for example, the cash account showing as the balancing figure this year is to 100, but bank statement says the cash within the company is only to be $70. So that there will be a difference between these two, and hence what we need to do is where we're going to reconcile the cash account onto the left hand side, and we also need to reconcile the bank account on the right hand side. So if we were to reconcile the cash account onto the left hand side, that's called the error correction. It's simply because we've made some of the errors within our cash account, within our company, so we're going to correct those errors. If we were to reconcile the bank statement, so that's called the bank reconciliation statement. So before we dip into that of how to prepare for that, the first thing we need to understand is why there's a difference between 100 and 70. So from my perspective, there will be three particular reasons behind it, and we can call it as the TEN. 10. So the first T stands for the timing difference. So why this is the case is because, for example, the customer goes into our office and gives me a check worth at $100. So what we need to do from a company's point of view, we need to approach the bank, and then we're going to update this $100 because we're going to receive this $100 from the customer. So we need to update our bank account numbers. But since we haven't gone to the bank and tell the bank what's going on, so that the bank statement will show a lower figure compared to our cash account because we haven't gone to the bank to receive this money. So this is called the timing difference. Within the timing difference, it can be detailed into two. Firstly, it would be the outstanding lodgement. Is what we've seen before. Received a check from a customer, but we haven't gone to the bank to clear up this issue. And another circumstance would be the unpresented check. So what do I mean by unpresented check? Is that when we bought the inventory, for example, we sent out a check to a supplier. The supplier received the check but haven't gone to the bank to receive the money from us, and hence of course we haven't deducted the value from our bank account because the bank is unaware of this because the supplier hasn't gone to our bank, and hence that's caused the unpresented check. Okay. Secondly, because of error exists. So errors may exist mostly into our cash account, or sometimes within our bank statements as well, but mostly within our cash account. So what we need to do is we're going to correct those errors. For example, we should debit the expense and credit the cash paid, but maybe the accountants at that particular time preparing the journals are too tired. They have written debit the cash and credit the income, and hence, of course, this will misstate the cash balances within our cash account on the first side. Of course, it will misstate the financial statements later on as well. And thirdly, it would be because of the unrecorded differences. So what do I mean by unrecorded differences? For example, if we open up a bank account, the bank would charge us an administration fee for each and every year. And that administration fee will be deducted from a bank account automatically in each and every time during the year. But because the bank has deducted it in the first time, maybe we haven't updated the records in our cash account because the bank hasn't told us about that particular issue. So what we need to do is we're going to adjust our cash account in order to show that amount as well. So those are the 3 reasons why the 100 may be different from the 70. So what we need to do right now is that from the accountant's point of view, how we're going to prepare the bank reconciliation statements and also how we're going to reconcile that cash account as well. Of course, for most of our junior financial accountants in the real life, the first thing that they have to do within this company when they first they enter into a company such as me, enter into the company as the financial accountant, I do the bank reconciliation statements. I love tick and cross. It's quite funny. So let's see how we're going to do this using a real life example. So this example is within your study notes by APC. So this example is called Jim. So Jim has his cash account or cash book because we're going to post the totals from the cash book to the ledger account here. Also onto the next page, you've also got the HSBC Bank for the Jim's bank statements as well. As you can see, the HSBC Bank to Jim, account number, the date, and also we've got pay out from your bank account and pay into your bank account so that it will update your balances. So as you can see, we have got the debit as well as the credit sides here for the bank balances here. So bank statement is the statement of financial position from the bank's perspective, for example. So what we need to understand is that if it is showing as the credit balance within the bank statement, this means that the bank is owing us money. If the bank is owing us money, of course it's the credit balance on their account. So that it will be a debit balance into our cash accounts within our company. So that, of course, as you can see, the total balance as at the 24th of October is to be 19,550 credit. This means to us, it is the asset, is the cash asset, is the positive cash balance within our company. Okay, so that's the thing that you need to bear in mind. So what we need to do then is that firstly, we are going to prepare the bank reconciliation statement. So the pro forma that we're going to use is that we're going to use the balance that is not adjusted from the bank statement's perspective. And what we need to do is we're going to adjust for the timing differences. Firstly, we're going to plot the outstanding lodgements. So why this is the case is because we received the money from a customer so that we've updated our cash accounts in the first side. But we haven't gone to the bank to clear up this issue, and hence we need to plot the outstanding lodgements into the bank statement in order to reconcile it. And also we're going to minus the unpresented checks as well. So what do I mean by that is that we send out the check to a supplier because we bought the inventory for maybe to buy the inventory for the first time, but the supplier hasn't gone to our bank to deduct this amount to receive this money from us, and hence within our bank statement we need to minus it as well. So once we've done with those, it can give us the balance that has been adjusted, and that particular balance should be equal to the cash account balance after reconciliation. So the cash account, we got debit as well as the credit. So firstly we got the balance that is not adjusted, and after doing those reconciliation, so that we end up with the carry forward balances, for example here, that amount should be the same as the amount within the bank reconciliation statement here. Okay, so what we need to do for the first thing we're going to do is that we're going to take the figures within the bank statement of 19,550 credit, which is the assets to the company here, and what we need to do then is we're going to consider the outstanding lodgement as well as the unpresented checks. The way that we're going to do it is that firstly we're going to be focusing on the cash book or the cash account on the first side. So what we need to do is we're going to compare those checks in place within the bank statement, and if something happens in the cash account but does not appear into the bank statement on the second page, this means that would be a timing difference. Either it would be an outstanding lodgement or it would be the unpresented check. So firstly, let's have a look at the check 345. So 345, tick for that. So 345 appears here, so that of course we don't have to adjust for it. Okay, so that's how we're going to deal with that, because there's no time difference here because it's been updated in both sides. Secondly, the check 95464 worth at 1,200, so here as well, so no need to adjust for that. And then we've got the check 741 worth at 1,100, so 1,100, 741 here as well, no problem for that whatsoever. And also we have got the check 6532 3,000. So those 3,000, 6532, you cannot chase in the bank statement. So what this actually means is the company has received a check from the customer so that they debit the cash within the company, but they haven't gone to the bank to receive this money, so that the bank statement hasn't updated this. So what you need to do is that this 3,000 is the outstanding lodgement here, so you need to adjust for that. It's related to a check of 6532. Okay, so what about for the credit side within the cash account? So we've got 1,437 worth at 450. So 1,437, 450 here. Tick for that. No need to adjust for that. 1,438 600 here as well. No need to adjust for that because there's no time differences for that. 1,439 750 here as well. And we've got 1,440 of 150. So 1,440, unfortunately, you cannot chase that within the bank statement. So which means what the company actually did is that they issue the check so that they credit the cash within its account. But the supplier hasn't gone to our bank to clear up their money, which means to receive this money from us, and hence our bank statement hasn't deducted this amount. So this is the timing difference, and this is called the unpresented checks. So 1,440 is worth at 450. So we need to deduct it at 150, sorry. So we're going to deduct it from the adjusted bank statement balance. Also we have got the 1,441 250, and we can chase that back from the bank statement. That'll be no problem. Also we got 1,442, which is 350. Of course, we can change that into our bank statements. That'll be no problem. We've also got 1443 for the 395. Unfortunately, this amount cannot be traced back into the bank statement, which means the company has issued a check, but the supplier hasn't gone to the bank to receive this money worth at 395, so that it is the unpresented checks. We're going to deduct it from our original bank statement figure. Also, we've got 1444. Unfortunately, again, we cannot trace back to the bank statement here. So what we need to do is we're going to deduct 165 again. And finally, we've got 1445. Again, we cannot trace this 1445 into our bank statement, as you can see. So that is another unpresented checks as well. So 1445 worth at 245. So that the balance in total, we got 19,550 plus 3,000, and we're going to minus those 4 unpresented checks, so that the balance after the adjustment is to be 21,595. So that's the bank reconciliation statements that we need to be able to know. But the question is, how are we going to reconcile the cash account as well? So for the cash account, the first thing you're going to do is that within the cash book, you've got the balance carry forward worth at 20 and 95. So what you need to do is 20 and 95. You're going to slot that into the cash account, into the debit side, because this is not adjusted yet. So what you need to do then is that you're going to stay back to our bank statement. You've adjusted all of those timing differences for the first side, but what about for the errors? What about for the unrecorded differences? So those are the things you're going to do right now. So within this particular bank statement, firstly, the figures unticked will be firstly related to the standing order from the HP PLC, which is paying out from our bank, which means the company should credit 750, but the company hasn't done that in its original cash book. So what you need to do then is that you're going to say we need to credit that, so this is related to the standing order of the HP PLC worth at 750. The second figure that's not been ticked is the direct debit for the Jargon Limited. So direct debit means, for example, we're going to deduct a fixed amount of money in each and every year, okay, from our account. Maybe we are using some of the service, so that of course you can deduct the amount from our company. So for example, an example here at APC is that we use the WorldPay to process the money, and of course the WorldPay would deduct the fixed amount of money from our bank account in each and every year. So that's what I mean by direct debit. So we should credit that 750 again. So direct debit 750. Another figure that we haven't recorded is the BACS transfer. So BACS transfer is just to be the bank transfer. It's the direct bank transfer. It's paid into our bank account, which means maybe the customer is going to pay his money to our bank account worth at 3,500. So what we need to do, we need to debit that 3,500. Yeah. So bank transfer 3,500. And then we've also got the bank charges of $500 here. It's not been recorded because the bank would charge you the fixed amount of administration fee for each and every month if you're going to use the bank service. So what you need to do is they're going to credit this 500 because it's paid out from your bank account, but you haven't recorded that into your books. So what you need to do is the bank charges worth at 500 here. So what you need to do then is they're going to total up those debit as well as the credit side. So because the debit side is greater than the credit side, so added up is to be 23,595. And what you need to do then is going to use 23,595 minus those 750. 750 is worth 500. So that will give us the balancing figure carry forward is to be 21,595, which would be the bought forward balance for the bank, for the cash, which is the asset to the company in the next month or next year. So that 21,595, black magic, as you can see, is the same as this one. So it means that we've done the bank reconciliation statements correctly, as well as reconciling the cash item, cash account with our company correctly as well. Okay, so that's how we're going to deal with the difference between the cash book and the bank statement. Okay, so that's how we deal with it, and that's the end of this section.
APC, accounting for your future.